Welcome back to The Deep Dive. We're your shortcut to getting properly informed without drowning in source material. We take that pile of reports you send us, figure out what really matters, and give it to you straight. Today, we're diving into Germany, the engine of Europe, right? Well, the latest economic data isn't just bad, it's actually pretty shocking. Get this. German industrial production. It's fallen back to where it was in 2005.
Yeah, 2005. It's a number that really makes you stop and think. Almost 20 years of industrial growth. Just gone, effectively.
So where is this coming from? What's the main culprit here?
Well, the sources are pretty clear on this. You have to look straight at Germany's powerhouse, the car industry. Their production didn't just dip in August. It absolutely cratered. We're talking down 18.5% compared to July.
18.5% in 1 month. From that sector. Okay, that definitely sounds like an emergency siren going off. So that's our mission today, right? Figure out what's behind this collapse. Is it a temporary blip? Maybe some weird statistical thing? Or are we looking at something deeper, more structural? And crucially, what does this mean for the risk of Germany tipping into recession?
Exactly, and the timing is critical. We know Chancellor Friedrich Merz is literally meeting with car industry bosses right now, or very soon, to talk about this mess. So we're basically trying to understand the data they're looking at, separate the immediate shock from the bigger picture.
Okay, let's start with that immediate shock, the August numbers. We mentioned the car industry's huge drop, but what about overall industrial production? It wasn't good either, right? Down 4.3% overall.
That's right, 4.3%. And that number itself is bad, but it looks even worse when you compare it to what economists were expecting. Reuters pulled a bunch of them, and the consensus was for maybe a 1% drop.
Just 1%? So they were way off.
Completely off, like by a factor of 4. That kind of miss tells you this wasn't just a gradual slide. It was quite sudden, unexpected.
Wow. Okay, so when you see numbers like that, you start digging into the historical context. How bad is this, really, compared to the past?
Well, if you filter out the huge, black swan events, the 2008 financial crisis, and the absolute peak of the COVID shutdowns, then yeah, the picture is grim. Industrial production overall is the weakest it's been since 2005, and it's still stuck almost 20% below where it was before the pandemic. It just hasn't recovered that ground.
Since 2005. I mean, that's sobering for the core of the Eurozone. No wonder analysts are using strong language. Didn't Karsten Brzezinski at ING say something pretty dramatic?
He did. He described production as dropping like a stone. I mean, that's not cautious analyst speak, is it? That's alarm bells.
And for the car sector specifically, you mentioned it cratered, but how does that stack up historically?
Again, setting aside those major crises, car production is actually at its lowest point since the year 2000. 2000.
Right.
So we're talking nearly a quarter-century low for Germany's flagship export industry. It's deeply concerning.
Okay. But let's not get completely swept away by the headline panic. We need to do our job here and separate the signal from the noise. Could some of this just be down to temporary factors, weird timing, statistical quirks, or is the foundation really shaking?
That's the crucial question. And yes, the German Statistical Office did point out a couple of things that made the August numbers look particularly bad. Temporary effects.
Right. What were those specific distortions?
Mostly timing issues, apparently. Things like the annual summer shutdowns at car plants. They happened a bit later this year, so more of that zero production hit the August data.
Yeah.
And also the timing of production changeovers for new models. Retooling the lines, that also happened at a cluster in August.
Okay, so holiday schedules and retooling, those are temporary. You shift a calendar. Maybe September looks a bit better purely from that effect.
Exactly. Those things smooth out over time.
But, and this is the big but, right? Even if you account for the later holidays, the underlying numbers are still really weak, which means something else, something bigger is going on.
Absolutely. You can't just blame the calendar. And we got a pretty stark reminder of these deeper structural problems just as this data landed. BMW issued a profit warning late on Tuesday.
Ah, okay. A major player like BMW sounding the alarm tells you this isn't just about when people took their summer breaks.
Precisely. It points directly to those ongoing long-term challenges.
So let's list them out. What are these big structural headwinds that the car industry is facing, the problems that won't just disappear next month?
Our sources highlight 4 really major ones, and they're all kind of tangled together. First, and maybe the biggest one, is the sheer difficulty Germany's having with the shift to battery electric vehicles. EVs.
Right, the EV transition. We hear about it all the time, but why is it such a structural problem specifically for Germany, the land of the combustion engine?
Well, it's more than just putting a battery where the engine was. It's a complete change in what makes a car valuable.
Yeah.
German dominance was built on, incredible precision engineering, mechanical parts. Now, the value is shifting rapidly to software, battery tech, digital stuff. It's like asking a master Swiss watchmaker who's brilliant with tiny gears and springs to suddenly become a top-tier software developer overnight. The skills, the investment, the whole mindset is different.
That's a good way to put it. It's a fundamental capability shift.
Okay,
What's the second challenge?
so second and third are really two sides of the same coin. China. For years, China was this massive growth market for German cars. But now they're facing really weak sales in China. And at the same time, they're getting hammered by intense competition from Chinese car companies.
Tell me more about that competition. It's not just cheap knockoffs anymore, is it?
Oh, absolutely not. Chinese EV makers, often with significant state backing and lower cost, are innovating incredibly fast, especially on the software and the in-car tech that consumers increasingly want. And they're not just staying in China. They're starting to push aggressively into Europe, directly competing with German brands on price, on features, particularly in that crucial mid-market segment.
So losing ground in their biggest market while facing new aggressive competitors from that same market. Ouch, what's the fourth headwind?
Geopolitics, basically. Things like the lingering effects of U.S. import tariffs, but also just the broader trend towards protectionism globally. It adds cost and complexity to those super optimized global supply chains that German manufacturers perfected. So you put it all together. A disruptive tech shift with EVs, collapsing sales in China, fierce new Chinese competitors, and trade friction. It's a perfect storm, really.
Yeah, perfect storm feels about right. And obviously, when the industrial heartland is struggling like this, it feeds directly into the wider German economy, the recession risk we mentioned.
Exactly. Germany's economy hasn't really been firing on all cylinders for, 3 years now? It's been stuck in this low-growth, stagnant phase. It feels like a chronic condition.
And this August industrial data is so worrying because it comes right after a negative Q2, doesn't it? The economy actually shrank by 0.3% in the second quarter.
Yes, and that's key. Remember, for the listeners, a technical recession is typically defined as 2 consecutive quarters where GDP falls. Q2 was already negative. So this really weak industrial performance in August puts Q3, it puts it right on the edge. It makes a second negative quarter look very possible.
Because Germany relies so much on exports, right?
Yep.
So when global trade gets tricky in manufacturing, their traditional strength takes a hit, the whole economy feels it. Are analysts already saying Q3 looks like it could be negative?
They're definitely worried. Ralph Salvin at Commerzbank, for instance, said these August numbers are further indication that the German economy hardly grew at all in the third quarter.
Hardly grew at all. That sounds like code for zero, or maybe slightly negative.
Pretty much. It's right on that knife edge for sliding into a technical recession. The stagnation might be turning into actual contraction.
Okay, that's a pretty bleak assessment for the immediate future. But let's pivot slightly. Our sources also talk about what comes next, right? There's some political action, maybe some optimism further out.
Yes, there is a counter-narrative looking a bit further ahead. Despite the current gloom, there are forecasts predicting things will eventually improve. This comes mainly from the financial sector. The Association of German Banks, for example, put out a forecast suggesting the economy could finally shake off this weakness, but not until 2026.
2026, that feels a long way off when you're looking at 2005 production levels now. What kind of growth are they predicting for 25 and 26?
Well, for 2025, they're only forecasting 0.2% GDP growth, which is basically nothing, just flatlining. But then for 2026, they predict a jump to 1.4% growth. That's the significant uptick they're banking on.
Right, 1.4% is definitely better. But where is that supposed to come from? Surely not from the car industry suddenly fixing all those structural problems by then. Sounds like something else is driving that optimism.
It absolutely is something else. That forecast seems to be almost entirely based on one thing: a massive increase in government spending, initiated by Chancellor Merz. And critically, it's debt-funded spending.
Okay, debt-funded. Let's just clarify that for listeners. How is this different from normal government budgets? This isn't just routine spending, is it?
No, not at all. Regular budgets mostly rely on tax income, maybe some borrowing within strict fiscal limits. This is different. This is a very large, deliberate increase in national debt, specifically to pay for big, long-term projects. It's a major economic intervention. A big bet, really.
And what's the money being spent on? Where is this debt-funded stimulus going?
Primarily 2 areas: defense, modernizing the military, and major infrastructure projects. Roads, bridges, maybe digital infrastructure too. The underlying idea, the hope, is that pumping all this public money into the economy will boost domestic demand enough to sort of pull the whole economy up, even while the traditional export engine is sputtering.
So the government sees the old manufacturing model is in trouble, and they're trying to jumpstart growth using public debt, focusing spending inwards on defense and infrastructure. That sounds like a pretty fundamental shift in strategy.
It really is. It's a conscious pivot away from that extreme reliance on export manufacturing towards something more driven by domestic investment, financed by the state.
Yeah.
And some, like Heiner Herkenhoff, the head of that banking association, seem confident it'll work.
Yeah.
He said something like, "We are finally seeing a solid foundation for significant economic growth next year," meaning 2026, presumably.
But you have to wonder, isn't that just avoiding the core industrial problem? All those issues with EVs in China, they don't just vanish because the government starts building new roads, right? Are the sources raising concerns that this is just, papering over the cracks, a temporary boost that doesn't fix the underlying industrial decline?
That's absolutely the central debate. If the German auto industry and manufacturing more broadly can't adapt quickly enough to the EV world and global competition, then this government spending, even if it's huge, might just end up replacing the economic activity that's being lost. It might stave off a deep recession in the short term, sure. But does it create sustainable, long-term, profitable growth? That's less clear. The money's going into building things in defense, not directly into, say, winning the global EV race.
That makes sense. That skepticism feels warranted. Okay, so let's try and wrap this up for you, the listener. We've seen the immediate crisis. Industrial output thrown back to 2005 levels. The mighty German auto sector is reeling from deep structural problems, the EV shift, intense competition, especially from China, and there's a very real risk of a technical recession right now in Q3.
And then there's the proposed way out, pinning hopes on 2026 growth, driven almost entirely by a huge wave of government borrowing spent on defense and infrastructure, a significant pivot away from Germany's traditional economic model.
Which leaves us with a really critical question for you to think about. Given how deep these structural challenges seem to be underscored by that BMW warning, especially around the shift away from combustion engines, can government spending on tanks and bridges truly be enough? Will it offset what looks like potentially permanent damage to the industrial core that powered Germany for decades? Or is this massive government debt just masking the early signs of a longer-term decline in German economic power?
That's the multi-billion euro question, isn't it? And it shifts the whole discussion from just a temporary downturn to potentially a fundamental structural transformation for Germany and, by extension, for Europe.
A really important thought to leave things on. Thanks for diving deep with us today. We'll catch you next time.